Good morning and welcome to NYSE TV Live. I'm Kristen Scholler here in studio above the iconic trading floor. Well, it is no doubt going to be a busy day today on Wall Street. The October jobs report just hitting. Amazon and Apple earnings came out last night, and traders are preparing for next week's presidential election and a Federal Reserve decision. Well, let's take a look, of course, at this morning's job data that hitting at 8:30 a.m. Eastern. The economy adding just 12,000 jobs last month. The unemployment rate holding steady at 4.1%, and average hourly wages up 4% from the same time a year ago. Well, in the wake of this morning's report, the market is setting up for a higher open, with traders mostly shrugging off this dismal jobs report due to last month's hurricanes and the Boeing strike. But it does come after Apple, the largest publicly traded company by value, late yesterday reported record quarterly sales. Its outlook did come in below expectations, though, and that stock is down this morning. Amazon, meanwhile, which has increasingly become a cloud play, did exceed expectations on the back of that cloud business, as well as advertising on its e-commerce portal. Well, so far this year, the S&P 500 is up an impressive 20%, but it did drop fractionally in October. Let's take a look at what's on tap in today's show. Well, as Election Day nears, the economy is a top focus for voters. We'll go under the hood of this morning's jobs report with EY Chief Economist Gregory Dacco. He'll join me soon. Plus, travelers from around the world are set to embark on New York City this weekend as the annual marathon takes place. MasterCard's Michelle Meyer is going to join me for a look at what it means for small businesses, local bars, and restaurants. And cryptocurrency, have you seen it? It has been on a tear of late. And Bitcoin IRA's co-founder Chris Klein is going to join me as both of these presidential candidates seemingly warm up to digital tokens like Bitcoin. Well, after that dismal jobs report this morning showing just 12,000 jobs added last month, I'm now joined by Gregory Dacco. He's EY's Chief Economist. Gregory, good morning.
Good morning.
It's great to have you on the show today. And what should our viewers know about the October jobs report?
Well, I think the first and most important element is that this was a very muddied report. We had a couple of hurricanes that unfortunately hit the U.S. During this the period of survey for the payroll survey. And we had a couple of strikes that reduced job growth. So this report is very hard to read when it comes to the underlying pace of job growth. We know that the headline print was only 12,000 jobs, but there was a major drag from both the strikes and the hurricanes. So when you look at the underlying trend, the underlying momentum in terms of job growth, I would focus more on the 3-month moving average of September. That shows that the U.S. economy is adding about 150,000 jobs on a monthly basis. That is weaker than where we were last year and shows reduced labor demand and reduced labor supply absorption, but nothing dramatic, no recession in sight, really just a softening of employment growth.
Would you still consider that 3-month average, Gregory, which you referenced there a moment ago, to be a healthy figure for the jobs market?
Well, certainly the October 3-month moving average of only 100,000 is distorted by the fact that we had this major disruptions in the month of October. So I would focus more on 150,000 over the course of the 3 months through September as a good gauge of where the labor market stands. And 150,000 jobs per month is healthy, but it is slower than what we've seen over the course of the past few years. And it indicates that business executives are being more cautious, more judicious with how they hire and who they hire. They're looking for specific skills, and they're not necessarily in great need of expansion when it comes to the labor force. So there is that underlying softening in the labor market that will likely lead to more softer consumer spending growth as we approach 25.
I do want to talk about wages. Average hourly earnings are a key element of the jobs report that we get every month, the first Friday of every month here on November 1st. But we do see that those rose 4% from the same time a year ago, and that is outpacing the inflation gains that we've seen. How does that factor into your own estimate for consumer spending going forward and the health of the economy?
Yeah, I think what we have to look at is really the monthly momentum in terms of wage growth. Yes, we did see wage growth pick up to 4%. The monthly momentum was 0.4 percentage points over the course of this month. I think what's important to keep in mind is that outside of some of these distortions, we're seeing moderating wage growth dynamics. And very importantly, when it comes to the Fed and where inflation pressures are coming from, an environment where you have wage growth at 4% is below the pace that would be consistent with 2% inflation when productivity is as strong as it is. Because let's not forget, productivity growth in the US is around 2.5%. So 2.5% productivity growth plus the 2% inflation target gives you wage growth around 4.5%. We're at 4%. So we're below that pace that would be consistent with 2% inflation, which tells you that there are very limited inflationary pressures coming from the labor market today.
Interesting. So sticking with the point of inflation, we did get that PCE index yesterday. That, of course, is the Fed's preferred gauge ahead of this Fed decision next week. Are you finding a bifurcation, Gregory, that we've seen in this economy for households at the higher end who have benefited from massive stock market gains in the past few years, and of course lower income consumers who are still struggling, it would seem, to really pay for those essentials in this environment?
Yeah, I think there's a misleading narrative out there that there is one consumer. The reality is that there are multiple types of consumers. Consumers that are at the lower end of the income spectrum are more debt constrained. They're more constrained by lower income growth. They have reduced savings buffers, and they're the ones that are exercising a bit more prudence. But consumers at the higher end of the income spectrum are still spending relatively freely. So you have this bifurcation in the consumer outlook. If you look at the broad trends in terms of the economy right now, we have a gently softening labor market, as we just discussed. We have more cautious consumer spending activity, and we have disinflationary fundamentals. All of the right ingredients to set the pace, the Fed, on this gradual easing pace of essentially easing monetary policy by 25 basis point increments to neutralize and recalibrate the stance of monetary policy.
So that's what I want to talk about. Of course, the Fed has maintained that it is an independent agency, i.e. it's not driven by politics or whomever is in the Oval Office. We know the Fed chair, of course, appointed, though, by former President Trump. I'm curious here, Gregory, with these key data points this week, GDP on Wednesday, inflation on Thursday, and the jobs report today, does that change your forecast for the Fed's path forward on cutting rates?
No, I mean, if you look at the broad set of data that we've received over the course of the past few weeks, you have essentially a picture of an economy that is gently decelerating. The labor market is not falling off a cliff, but it's not reaccelerating either. So you have gently moderating labor market momentum. Inflation, according to the Fed's preferred gauges, is within striking distance of and risk tilting to the side of excessive weakness. So the Fed needs to recalibrate monetary policy away from where it was when inflation was at 6% towards an environment that is much more balanced and where you need to be closer to a neutral stance of monetary policy. That means a gradual easing of monetary policy to avoid being or having to be excessively reactionary if the economy slows further.
One thing I want to ask you, Gregory, as an economist, is we've seen the stock market now in its second year, past its second year of a bull market, up more than 60% roughly from that October 2022 low. How do those stock market gains funnel through to economic activity?
Well, they funnel in different ways. For households, they funnel via the wealth channel. So individuals that are invested in the stock market benefit from those stock market gains via the wealth channel. And one of the interesting dynamics post-pandemic is that we've seen a greater marginal propensity to spend out of wealth for wealthier individuals. And that's been one of the key reasons why individuals at the higher end of the income spectrum have been doing more than their fair share of overall spending when it comes to consumer spending activity. That's one way. The other way is that it continues to support business investment. And you continue to see business executives, especially the ones across the sectors that are doing the best, that are continuing to invest, continuing to drive growth forward, and continuing to look to expand, even though there is more subdued growth momentum in the broader U.S. economy.
Gregory Daco, EY Chief Economist, thank you for joining us early this morning after that October jobs report. Well, from the economics of the jobs market to the business boost of the New York City Marathon. My next guest will join from MasterCard Economics Institute to give us a glimpse into the event economy. Michelle Meyer is going to be with me on the other side of this short break.
Hello and welcome to today's edition of The Exchange, brought to you by the New York Stock Exchange. I am live on the floor with my friend Simeon Hyman. He's Global Investment Strategist at ProShares. Simeon, thank you for stopping by.
Thanks for having me.
I can't believe I'm saying this. We're coming up on the 3-year anniversary of BITO, B-I-T-O. That's the ProShares Bitcoin ETF. How's it going?
You were here with me. October 2021.
I remember we were staring at the screens behind us. We were excited.
The volume was off the charts. I think we had about $1 billion in the first 4 hours.
Yeah.
The fund has continued to prosper, and we keep moving. We now have the most crypto-linked ETFs as in addition to BITO.
So let's stay on the ETF. You know, we talk a lot about the benefits of the ETF wrapper. Are there benefits to the idea of Bitcoin in an ETF?
Sure. Let's start with the ETF itself. You can buy and sell in a brokerage account. You don't need a wallet. Now you have the futures, which are a regulated space as opposed to the loosely regulated spot markets and third-party providers, and you have a qualified custodian. But you bring up a second point, which is important, the distinction between our futures-based ETF and the spot Bitcoin ETFs. BITO is a 40 Act fund as opposed to the spot Bitcoin ETFs, which are 33 Act funds. And some folks do want a registered investment. Important, there aren't options on the spot, guys, and it's a robust spot market, the largest of the crypto-linked space. And again, that regulated futures market is important.
It is. And, you know, as you mentioned, the options market, I mean, boy, options have just been booming this year. We're seeing it in message and traffic. I want to take us forward, though. So it's been 3 years since BITO has been listed here at the New York Stock Exchange. What else have you been working on over that time?
We're up to 10 crypto-linked ETFs in our suite. We're super...
Good morning and welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio above the trading floor. Well, as always, even on this Friday after Halloween, we are bringing you all the news and happenings here at the NYSE, including a conversation up next about the NYSE Marathon and, of course, what it means for the business boost. Well, more than 50,000 athletes are going to run in the marathon this weekend. The 26.2-mile race spans all 5 boroughs and typically attracts more than 1 million spectators. Well, joining me now with more on what we can expect is Michelle Meyer, Chief Economist for MasterCard Economics Institute. Michelle, good morning.
Good morning.
It's great to have you. And of course, many people preparing to either run, watch, or volunteer. What is the business boost that you expect to come out of this year's marathon?
Well, the Big Apple certainly is preparing for quite a lot of excitement this Sunday and throughout the weekend, frankly. And we were really intrigued by that. We've been in the MasterCard Economics Institute studying events, whether it's sporting events or concerts or some sort of natural event in the economy, like the solar eclipse. And what we've done this time around is we've really focused on how the New York City Marathon will impact spending along the path of the marathon, particularly small businesses, particularly those small restaurants that see this big influx of activity. And we have the ability to do this because we can look at real-time spending trends, and particularly at a really hyper-local level. Mm-hmm. So what we revealed in our recent blog that we published by examining last year's marathon is that spending increases across the entire path of the marathon. And you see the peak increase in spending right between 2 o'clock and 3 o'clock as those runners are getting to the Upper East Side towards the finish line. And if you look at the boost to spending at small restaurants last year, it was in the order of about 40% relative to its underlying pace of growth. So it's quite impressive.
Impressive. Well, certainly we've had a few warm days here in New York City, almost 80 degrees for Halloween and 77 today. But the weather is set to cool down a bit, of course, on Sunday. Forecast to be cloudy and 58 degrees. What role does the weather play in the economic activity that we can expect from spectators watching this event?
Well, we didn't control for weather when we ran our analysis. So, potentially it's a challenge if you see people, more hesitant to go out and watch. But look, I think runners are committed. We see it over and over again, regardless of which cities, which time of year those marathons occur. Runners are out there, and supporters and spectators are as well. So my sense is that we will see quite a lot of activity this Sunday as well. Similar potentially to what we saw last year when we examined the data.
We've had a decent amount of economic data this week, Michelle, between the GDP report, inflation, the jobs data this morning. What is that indicating to you about the overall health of the consumer and their willingness to spend?
So the data has been fascinating that's come out. So we just got the jobs report this morning, and the headline number was a bit soft in terms of non-farm payrolls, quite soft. But it was distorted. We know that there was the hurricane impact. We know that there was a strike. And in fact, the Bureau of Labor Statistics provides some really helpful estimates of the non-respondents into the survey and how much that data might be distorted by these special factors. So if you look past that and you look at the unemployment rate hovering at 4.1%, we're still seeing very strong growth in the household survey, which doesn't have those distortions. So my sense is that the economy is still humming along in terms of adding jobs as well. And if the GDP report earlier in the week was really quite consistent with that, a strong headline number, and what really stood out to me is consumer spending in real terms was up just over 3.5%, so in excess of that, showing that consumers are out spending and actually seeing more real volume in across the spectrum in terms of goods and services.
Quantify, Michelle, if you can, just how much events like the marathon, like the Eras Tour are driving overall economic growth.
So what we see is that it impacts the decisions that consumers make around how they're using their purchasing power. So what we've seen from the consumer in the last few years, really since the pandemic, is a really mindful consumer in terms of how they are out there engaging in the economy. And when there's these moments in time, whether it's to see a Taylor Swift concert or to see a marathon or to go to a sporting event, when it's meaningful, consumers are able and willing to spend. And it really shows that they are empowered right now. But they also, of course, have that support because of the economy that we're in, with GDP growth continuing to run above trend, job creation on a trend basis also in excess of where we had been prior to the pandemic. So they have that support from the economy to make those choices and engage in that experience economy.
What other events on the horizon, Michelle, do you think could boost economic activity?
Well, Taylor Swift is still out. So I think that's still a big story, and we certainly hear when her concerts come through smaller cities in particular, how tremendous it is in terms of creating an activity of tourists coming in, greater spending in restaurants, greater spending on lodging. But I also think in general, just the sports economy is really quite important now. There's so much enthusiasm, such a strong fan base, and people that really want to participate. So we are still seeing that economic activity coming out of sporting events.
All right, Michelle Meyer, Chief Economist for MasterCard Economics Institute. Michelle, thank you.
You got it. Nice to be with you today.
Great to see you this morning. Well, one event that we've seen impact the economy over the past month is extreme weather. Hurricanes Milton and Helene left communities devastated in their wake, and the New York Stock Exchange's parent company, Intercontinental Exchange, is leaning into the climate economy, recently launching an offering for private companies to assess climate risk. On the other side of this break, I'll be joined by the Vice President of Sustainable Finance Data at Intercontinental Exchange, Larry Lawrence. Stay with me.
Hi, I'm Isabella Bizone with Fixed Income in Focus. Today, I'm pleased to have with me Laurent Poyac, Group CEO at Millennium Advisors. Laurent, in the world of credit, we've seen a lot of change in market structure in the last 10 years with the growth of algo trading and all-to-all platforms. How have these new developments affected liquidity in fixed income markets?
Well, first of all, thank you for having me, Isabella. You have run a very good program. I'm pleased to be here. I'm going to share my perspective as a prop trading firm that has acted as an alternative liquidity provider in fixed income. Yes, market evolution has really transformed our markets for the last 10 plus years. With the advance of algo trading, we've seen a lot more participants. Now, every single investment bank have an algo desk, as well as alternative liquidity providers like prop firms are very active in the algo trading space. With more data and the usability of AI in those markets, algo trading firm has created a lot of value. But what we found is that the liquidity they provide is really robust, mostly in a low volatility environment. All-to-all platforms have also expanded, and there's more than one platform today, and it's really blurred the line between the buy side and the sell side. But again, liquidity has been strong, mostly during low volatility environment. At time of market disruptions, that's where we see the weakness of these evolutions. We all say that in the credit markets, liquidity is a mile wide and an inch deep. And at Millennium, we approach it a bit differently. We use algorithms to help us making decisions, but our model is really more trader-centric. And we use automations to help our people make faster and better decisions and respond.
Good morning, welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio as we await the opening bell. Well, the climate economy is a growing business as hurricanes, tornadoes, and unusual temperatures become more commonplace. Intercontinental Exchange, the parent company of the New York Stock Exchange, is expanding its business in the climate category. It recently announced plans to launch new climate risk assessment data for private companies. Vice President of Sustainable Finance Data at Intercontinental Exchange, Larry Lawrence, joins me now with more. Larry, it's good to see you.
Yeah, thank you for having me. Great to be here.
Great to have you. What does this new data intend to cover?
Yeah, absolutely. So we recently partnered with our friends at Dun & Bradstreet, and this is a perfect example of working together to create solutions that meet sort of the rapidly evolving needs of our customers and clients, including regulators and investors. So combining Dun & Bradstreet's business intelligence, supply chain, and asset location data enables us to get more accurate with where companies are located and exposed geographically. And combining that with ICE's geospatial and climate capabilities, we can give our clients and investors pretty unique insights into exposure to extreme weather events, whether it be wildfires, hurricanes, or floods, as well as give them more analysis and analytics on the emissions implications of all of those locations and the geographic footprint of these organizations. The new service will offer something quite broad to the investment community, the single source of climate data for virtually all business entities globally. As you may know, sustainability has been certainly a hot topic in the industry, and more the availability of data to gain transparency into what you own and your assets are becoming more and more critical. And the next wave of interest is around the private company universe. So this collaboration with D&B will help deliver a significant amount of transparency around the climate, physical, and transition risk of private companies globally.
How much of the market will be covered, Larry, in this data?
I mean, we're talking tens of millions of private companies, so we're thinking most of the market will be covered with this data set. It will take time to sort of get to all of the esoteric small organizations around the world, but by and large, in any significant company, private company around the world will be covered. And in addition to that, we've also integrated significant data around the supply chain. So that brings in an additional tens of millions of companies into the mix and into this data set.
ICE, in this effort, is collaborating with Dun & Bradstreet on the new data. How does that partnership enrich the offering?
It does a couple of things. One of the biggest challenges we've seen or heard from our customers is that it's tricky and difficult to capture accurate asset location data. Let's just say you were working, let's just say you were an investor and you had exposure into a given company. Understanding where the factories, distribution centers, employees are located and distributed across the globe is a pretty difficult thing to do. So this collaboration will provide insight into a pretty large universe of asset level data that we will combine with our climate analytics to deliver, I think, sort of transparency that really investors hadn't seen before. So this is quite new and significant.
We saw earlier today extreme weather impact the jobs report, just 12,000 jobs added in the month of October. And part of that was because of the hurricanes, both Helene and Milton. We know that this weather, extreme weather, can have an impact on the housing sector, probably most directly. So how is this data provided by ICE helping real estate investors, for instance, make better decisions?
Yeah, over the last 5 years, we've seen insurance costs increase for homeowners all over the country. We can map trends at the zip code and county level. And what we've seen is if premiums continue to increase, and as they have been in many parts of the country, affordability challenges for homeowners will likely be compounded with housing valuation depreciation in these high-risk areas where you're seeing more extreme weather events. Ben Keyes at Wharton and others have already seen these kinds of effects in risky areas such as Florida. I think they published a paper on that recently. So the kind of depreciation risk in high-risk areas at large scales could impact millions of homeowners, as well as investors of mortgage-backed securities. The impacts could be equally significant for business owners and investors in commercial mortgage-backed securities. So ICE, and where we sit with the sort of the data that we sit on top of, we're uniquely positioned to provide insight in insurance risk due to the work that we're doing in this space. So there's been increasing attention paid to how these extreme weather events impact assets on the ground, but increasingly in the investment world, clients are asking us how those link back to the securities that they hold on their balance sheets and in their portfolio. So these events are quite significant, and questions are being asked about them quite broadly across the industry.
How would you recommend that investors, Larry, use ICE's data to navigate that dynamic insurance market amid extreme weather?
Yeah, so there are a few things we can do. As you know, our mortgage data and technology business have done a lot of work this year and in previous years to collect insurance escrow data to help understand where there are insurance gaps across the country based on the loans that underpin a lot of these properties. So that's one way. We're also uniquely positioned to provide insights. We recently partnered with an organization called Delta Terra, a research and analytic firm that builds rigorous market-calibrated models that help translate these climate projections and insurance market data into asset price depreciation risk and pool level projections at different economic and climate scenarios. So we have the data that can help you integrate these risks into your credit analytics today, plug and play more or less. So there's a lot of work that we can do and a lot of help that we can provide in helping measure and understand where you're exposed and how these risks may impact the assets that you hold on your balance sheet.
Larry Lawrence, VP of Sustainable Finance Data at Intercontinental Exchange. Larry, great to see you this morning, and thanks so much.
Thank you.
All right, well, you might have heard some cheering behind me. Of course, the stock market set to open for trade, rounding out October with just fractional losses, still up about 20% this year on the S&P 500. A whole host of earnings to cover. A company set to ring the bell, Everus, as well as that key jobs report this morning. 12,000 positions added last month. That was below the 100,000 expected. But as we've been covering throughout today's show, of course, that was largely impacted by the Boeing strike and, of course, those hurricanes Helene and Milton. All of this sets us up to start November trade here momentarily as we await that presidential election next week to determine the balance of power in Washington, the potential impact on you and your money, as well as the Federal Reserve decision, which is set to hit on Thursday next week. Usually we get that on Wednesday, but pushed back just today, of course, because of that presidential election. So as we set to open fractionally higher on the major indexes, we are going to take you to the opening bell in just a few moments as Everus, a construction company, is set to celebrate the opening bell. we are officially off to the races on Wall Street. It has been a very busy week, and we have no shortage of topics to discuss on this Friday. Stocks opening fractionally higher here on Wall Street. And of course, joining me now with more is Jay Woods, friend of the show and Chief Global Strategist at Freedom Capital Markets. Jay, good morning.
Good morning to you.
You've been a very busy guy, so we appreciate you taking the time, especially on this Friday after Halloween, starting November trade. What position are the major indexes in?
Well, right now we're in a position to rally. We are coming into the beginning of the 6-month best streak for the market. November through April seasonally are fantastic. November's been up 11 out of the last 12 Novembers. But there's something next week. I forgot what it is that everyone's kind of focused on. Oh, yeah, the election.
A few things, right?
The election, yeah. My gosh, yeah, our head is spinning just from earnings down here this week, economic data. Then next week is the cherry on top with the election, the FOMC meeting. So we won't have enough time to talk about everything moving these markets. But let's just focus on November, turn the page. October finished lower, 5-month winning streak over. We had a 5-month winning streak before this 5-month winning streak, which started last November. So let's hope that this November starts another winning streak. I like how the stage is set going forward, but we'll see. One data point, one earnings at a time.
So I want to ask you more about that because we did see a disappointing jobs report this morning. Even if you strip that one out, we see the 3-month moving average come in a little bit lower in terms of job gains, let's say roughly 150,000. Earnings still by and large beating expectations, but that third quarter GDP growth a little bit lighter than expected. How much is this growth narrative going to drive the market going forward?
Well, so much to digest. Let's talk about the jobs number first. That number was a little wonky. We expected it to be that way because of, as you mentioned in the segment beforehand, hurricanes, the Boeing strike. Revisions a little lighter, but it's 4.1%. We're still trending and holding steady, which is good for the Fed as they go into this meeting next week. GDP, a lot of revisions there, did not move the needle. Earnings we're seeing hits and misses across the board, but we're seeing consistent growth. One that stuck out to me yesterday was Uber, which trades right behind us here. They got hit a little bit harder than anticipated after a solid quarter. I think that could be an opportunity for somebody who's been waiting for a buy the dip opportunity. But we're seeing consistent growth, steady growth. And to me, I think that's the story. So those that got hit on better than expected earnings may give investors an opportunity. And then some of the bigger names like Amazon today about to break out to major new highs if it can close above 200. So we're watching earnings pockets carefully, but the overall trends can continue to be higher.
I do want to talk about artificial intelligence. We know that this has driven the market rallies, certainly in the past year or so. I saw a Wall Street Journal headline this morning, tech company AI investments starting to pay off, even though we've seen some of these semiconductor companies and even some of the big tech names come under pressure to end October. How much of the market narrative is clinging to what we hear on artificial intelligence?
Well, it is the big headline grabber and is where all the big companies are spending. So what we've been focused on the first half of this year was that capital expenditures, CapEx. How much are these big companies spending on that AI growth? And then now what we're focused on is, are we starting to see results from that? And I think we are. Amazon CEO Andy Jassy was very positive about the spending is going to pay major dividends going forward, and that's why the stock is acting favorably. It will continue to be one of the top stories going into next year, as will cybersecurity, which we take very seriously here at the New York Stock Exchange.
Yes, I do want to talk about industrials. Everus Construction Group celebrating the opening bell today, of course, as we turn a new leaf, prepare to turn a new page in terms of who will be in the Oval Office. We know that some of these industrial companies have received a lot of cash injections from fiscal policy in the Biden administration. Are you seeing that start to funnel through to earnings?
It is, but what we want to focus on is what's next. And unfortunately, in this sector, a lot of people are focused on the election. But if you remember, under the Trump era, industrials had a nice run. We were supposed to have infrastructure week many times, but it is a key focus of the Trump administration. And under Biden, that has been a continual focus. And if you look at it, it's not the sexiest sector. It's not making headlines because it's not the big AI story or tech story. But industrials had, are up 13% year to date, underperforming relative. Boeing's also part of that, and that's been a drag on the industrial sector. But what we're seeing is slow and steady growth. The housing market has been robust. If we get mortgage rates to come in, it's going to be a boom for some of these industrials, especially on the home building side. So I think it's going to be slow and steady, not make headlines. It can be boring to some, but not for the people ringing the bell, that's for sure.
What do investors need to know about how this presidential election might impact them?
Okay, put on earmuffs. That's what I tell everybody. You're going to get some headlines that are crazy. The VIX is elevated. The VIX is over 20 all month in October. We dropped 1% in the S&P 500. People are braced for the worst, but there are 500 great leaders at the S&P 500 level with the companies that they run. They're focused on what this election will mean to them, to individual earnings growth. So we've seen this in 2016, where we bottomed in the quarter in November. We rallied into year end. We saw it in 2020, bottomed, rallied into year end, even through an insurrection, believe it or not. So the headlines will be epic. I cannot predict who's going to win the election, but I can predict that the market will like the fact that we've gotten through this cycle, and we'll get back to focus on the 500 companies that make the S&P 500 grow, the small cap companies that have been lagging the index, and focus on earnings growth and what their path forward over the next year with whomever wins the White House will be, and how that will impact their bottom line.
Jay, we always appreciate your time and your insights here on NYSE TV. Jay's the Chief Global Strategist at Freedom Capital Markets. Thank you.
Thank you.
All right, well, the election is the storyline, of course, driving our viewers in the past few weeks or so. And so, as we see, stocks usually rise during election years. That certainly has been the case this year. Election day just 4 days away, and so let's take a look at this video from ICE and the NYSE as part of their vote campaign heading into the break.
Together, we achieve greatness.
A house divided against itself cannot stand.
Ask not what your country can do for you, ask what you can do for your country.
One small step for man, one giant leap for mankind.
Technology is very important to us. Actually, we are one of the first companies in the industry to fully adopt cloud-based software applications.
Stephen, it is wonderful to have you on Floor Talk here at NYSE International Day.
Thank you. Thank you for having me.
So now, I want to start off by talking about the company. Tell me about NYSE.
Thank you. So we are NYSE, short for CYYS. We are China's largest freshly made tea drink company. So we are directly operated. Currently, we have 900 stores across the country with more than 6,000 employees. So we were founded in 2013 in Changsha City from China. So on top of the fresh made drinks, we also offer lifestyle retail products like these ones. So we started offering them since 2020. Right now, it contributes to more than 30% of our total sales. To my knowledge, that is the highest in the industry.
Now tell me, how does technology drive the customer experience?
Technology is very important to us. Actually, we are one of the first companies in the industry to fully adopt cloud-based software applications. Just to give you an example, so people are familiar with the Starbucks apps. There are a lot of functionality in it. So we also have a similar WeChat mini program in China. So for example, if a customer is interested in to buy one of these retail products, they can use our WeChat mini program to search exactly which store has the inventory. And once they find it, they will be able to either to buy it or they can.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. We are officially open for trade on this Friday, November 1st. And as risk assets like stocks sit near record highs and the election approaches, cryptocurrency has been on a tear. It's been a bullish year for Bitcoin after the SEC approved a Bitcoin ETF in January. It was only recently, though, that Bitcoin topped 70,000 a token again for the first time since July. The cryptocurrency above 70,000 this morning. So joining me now with more on the crypto market is Chris Klein. He's a co-founder of Bitcoin IRA. Chris, it's great to have you on the show this morning. And as we see crypto elevated at these levels, do you think the momentum can continue?
Absolutely. Pleasure to be here. Thanks for having me today. It has been a banner year for cryptocurrency overall. And we're headed into an election cycle, which is really just gasoline on top of the what I like to call the napalm of halving event taking place. We're about 200 days off of that cycle in April, with peaks expected around 550 days post-cycle halving event.
Interesting. Now, of course, the election in key focus next week, not just for stock investors, but I'm sure for the crypto community as well. How is the community viewing the election and the potential outcome?
Absolutely. Well, you know, we had 2 of 3 candidates come to our event in Nashville this summer. So we were part of the conversation and very happy to be part of such. But also we stick to the fundamentals of our supply, demand, and halving events. You're going to see a lot of volatility. It's interesting. Bitcoin won't close for the weekend today. It will be open, and we'll probably see even more volatility across the weekend headed into Tuesday. But I think it's important to take a step back and realize that neither candidate at play for next week has a silver bullet for some of the major fundamental issues like inflation that is sticking to us, as well as our massive national debt.
What do you think will be the main drivers for the price of the crypto market going forward?
Well, first will be the halving event. We're cutting the supply down through our mechanism, through the cycles that we go through. So you have ETFs that have been approved and are putting billions into circulation every day. At the same time, we're cutting down the reward for creating more Bitcoin. It's a great paradigm of supply demand that's ahead. A lot of technical experts are calling for $100,000 Bitcoin early next year, and some of the more bullish ones are expecting near $200,000 Bitcoin at the peak of this cycle in about April or May of next year.
How much of that does, though, hinge on the impact of the election? We've seen both of these candidates really kind of warm up to cryptocurrency of late, of course, at the urging of some mega players in the entrepreneurial space. But that plus regulators, I would imagine, Chris, that would be crucial to a sustained move higher for crypto.
Absolutely. So being part of the conversation, as I mentioned, and also just a natural pro sentiment towards the reality that crypto is here. It's become mainstream, and it's a part of our overall, not just domestic economy, but at a global level in the conversations about currency happening overall overseas. So those two characteristics are huge as far as where we're headed into the next year. But I think most folks, especially in the crypto space, we represent retirement thinkers. So these are long-term holders or hodlers, as we like to call them, that are looking for a potential hedge or store of value, which is part of why you saw Bitcoin almost reach all-time highs a couple of days ago, and gold setting new goals or new highs this week as well. Investors are looking for that diversification play.
I think you bring up a good point there, that it's become more mainstream. And certainly I think that decision from the SEC earlier this year, the backing of these presidential candidates has helped to that. Of course, the addition to 401ks, the fact that in your retirement account, you can now actually invest in Bitcoin through well-known brokers like Fidelity certainly has helped, but it still is a volatile market, Chris. I'm sure you would agree with me on that front. And so how should investors and traders navigate the volatility that they might see outsized in this space?
Oh, absolutely. So long-term holding and mentality, dollar cost averaging, all the basics that you do with any other asset class that has volatility. Also, there's over 2,000 different cryptocurrencies at play today. Bitcoin is the banner. It's the big boy of the market. But there is a lot of fundamentals happening inside of Ethereum, Solana, Chainlink, and others. Doing your homework and research and understanding these, and also just in general getting off zero. I've been doing this, I feel like an old man now, since before 2017, back when it wasn't mainstream and we weren't even talking about ETFs being in place. But people are looking for a fundamental piece of financial freedom when they make these choices. They're getting off of a dollar-derived asset class, which we're at monetary supply levels that are growing again, and we have concerns overall of inflation and how far our dollar can go. So when you're thinking of cryptocurrency, day trading is not for the weak of stomach. And most of our folks are looking at this as a long-term hold, somewhere in the 3 to 5, maybe even 7 to 10 year process. My 10-year-old daughter, in fact, has her first Roth IRA a couple years ago. And the first thing she wanted to put, other than Zynga stock, because she loves Tokaboka apps, was Bitcoin and Ethereum for long-term for her college savings.
All right, Chris Klein, co-founder of Bitcoin IRA. Chris, thank you so much for joining today. We'll check back in with you hopefully at another time. All right, well, stay with us because up next we'll talk about more news coming out of Money 2020, including a new way to make it easier to take care of all of your business travel arrangements and the expense reports that come with them. Stay with us.
You know, you think about it, providing energy does improve lives. Your life gets pretty miserable pretty fast if the lights go out, if you can't get the fuel you need to get from point A to point B, groceries don't show up on the shelves, you can't get your kids to school. It's a tough life without energy. And so our mission is to make sure that people have access to the energy and the materials they need to have a great lifestyle, to have a sustainable lifestyle. And over the years, we know that it's going to evolve. The kind of energy we may be providing to improve people's lives may evolve from what we do today, but we're committed to ensure that people have access to low-cost, affordable, sustainable, abundant energy, just like we've done for the last 125 plus years. Pinnacle really epitomizes the perfect opportunity for us because it sat right next to our backbone, our trunk lines. It had a brand new state-of-the-art gathering and processing facility that could process 200 million standard cubic feet a day of gas. And it had plans for another one and the utilities in place for another one. And there's room for even more expansion. So we could do an inorganic acquisition that allowed us to do more organic growth over the long term. And so we were able to buy it at a very reasonable value and create even more value by expanding it over time. Today, we're now processing 50,000 barrels a day, give or take a little bit, of renewable feedstocks with low carbon intensity, and we're selling it as renewable diesel direct to customers at our 76 stations in California and other locations on the West Coast. And we're now starting to build inventory of renewable jet fuel that can be blended with traditional jet fuel and marketed as sustainable aviation fuel. So we're well off to a good start with our Rodeo.
Welcome back to NYSE TV, everyone. I'm Kristen Schuller here in studio. And one of the big announcements at this year's Money 2020 came from Navan and Brex. These two former competitors have teamed up to present their customers with a seamless, integrated platform that marries travel management and expense reporting. The two entities realized that they had a number of customers in common, and the opportunity to create a bridge between the two platforms seemed logical. Hence, Brex Pay for Navan was created. The system allows for the automatic reconciliation of travel expenses that are booked through the platform. And in addition to saving hundreds of thousands of dollars in reduced Forex and bank transfer fees, not to mention boosting employee productivity by streamlining and automating expense reports. Well, another benefit of Brex Pay comes from more control over employee expenditures. Administrators can set and instantly change different expense parameters based on when and where an individual is traveling. Well, the savings in money and time will be notable as business travel continues to grow. And NYSE TV's Trinity Chavez spent this week out at Money 2020 in Vegas. She was able to sit down with Michael Sinisic, the CEO of Navan Expense, to talk more about this collaboration.
Navan automates travel and expense for customers. What we do is we provide travel agency services and booking tools along with expense management and payments to really complete that whole circle and automate T&E for our customers, both the employees and admins.
And I do want to talk to you about your recent announcement, your partnership with Brex Pay. You're talking about it here at Money 2020 in Las Vegas. Can you talk to me about why you chose this partnership, why it's so significant, and how it's impacting the broader broader travel and corporate travel landscape?
Yeah, so Navan and Brex have been formidable competitors for a very long time, actually, and we both play in semi-similar spaces. So Navan focuses a lot on travel and travel management and expense technologies, and Brex has been building global banking services and cards and other types of expense management services for customers. And as we've grown over the years, we have tons and tons of overlapping customers, more than 1,000 actually, that have been recently saying, hey, you guys, we love you for travel or travel and expense. We love Brex for cards and banking. Why don't you guys work together and build a solution that can help automate this and provide great reconciliation for our travel payments? And that's actually what we did. So when you think about Brex and Navan together, we've got about 30,000 customers in total, managing more than $15 billion a year of travel and expense spend through our platforms. And we thought that it's a great opportunity to really focus on the customer and provide a lot of automation for them.
Well, and I love how you actually listened to your customers and you made it happen. But talk to me more about how this partnership is different from all the other corporate payment plan strategies, especially when it comes to expense reports that are currently on the market.
So we're both modern tech companies, right? And so when these two companies came together and thought about really innovative solutions, we focused first on how we can build seamless API integrations such that if someone makes a trip booking in Navan, we automatically generate a new virtual card from Brex to be able to tie that to that booking. We perfectly reconcile that in real time, and everything is automated and nobody needs to do an expense report. On top of that, you can come to the Navan Travel and Expense app and you can actually order Brex cards for your employees. You can cancel them. You can put policies from Navan deeply embedded onto the Brex card to say, maybe if I'm traveling, that employee is allowed to spend $75 a day on food, their Ubers and their Lyfts and their hotel bills. And if they're not traveling, it can be a completely different policy. So that level of deep integration is what makes this so special.
Now, I do want to talk to you about the different travel trends when it comes to corporate travel. We have seen an uptick in corporate travel from 2019 to today. Talk to me about what you think is driving this surge.
So there's definitely a surge in business travel. And to your point, when we compare the 2019 cohort to today, they're spending about 18% more than what they were in the past. There's a couple of things. Sales and marketing and conferences and events like this are back in full force. Companies are expecting that their salespeople are getting out there, they're getting in front of customers, and they're closing deals and driving the business forward. That's first and foremost what I think is driving the spend back on travel. We also see companies that have hired more distributed workforces are now bringing their employees back together once a quarter, once every 6 months to really meet each other. Imagine starting at a company and you've never met your coworkers if you're hired remotely. So we see that type of spend increasing a lot. And these are cohorts of people that have never really done travel and expenses at this level in the past, like your product people, your engineers, and your other types of employees versus just sales and marketing.
Are you seeing different trends when it comes to corporate travel in specific regions since you are a global platform?
Not outside of general seasonality. So for example, in Europe, August is usually a pretty slow month with vacations, so corporate travel slows down. In November, we see a slowdown at the end of the month for Thanksgiving, and then we see the holidays during the new year, and that business travel slows down, and personal travel tends to take up in those types of events. But at a global scale, I would say we're seeing business travel is coming back at all levels.
What's next for Navan?
We're going to continue to double down on our mission to really expand our travel and expense management product around the globe. We're very, very big in the US, and we've been doubling down in EMEA over the last couple of years. We're starting to expand furthermore into APAC regions. We made 4 or 5 acquisitions in the last couple of years in different geographies, and we're going to keep bringing our platforms to more of those companies in those areas. And we're continuing to go up market to larger and larger enterprise, and also down market into our product-led growth function, where companies now in the hundreds, if not thousands a month, are coming to our website and signing up for our travel and expense product.
Amazing. Well, thank you so much for joining me today.
Thank you very much.
All right, our thanks to our Trinity Chavez and, of course, Navan for joining us there from Money 2020. We will be checking back in with all of our Money 2020 coverage, of course, in the days and weeks ahead. Our thanks to Trinity for that. All right, well, stay with us because we are going to take a short break, but we'll have much more on the other side.
In today's industrial landscape, the health of machines is crucial to maintaining efficiency and productivity. Joining me today is Sar Yoshevitz. He is the co-founder and CEO of Augury. We're going to discuss their innovative approach, the future of the industrial AI adoption, and how partnerships with key industrial players have shaped their growth on this episode of Taking Stock.
All right, well, recent years have seen gambling, the experience, grow quite notably in the United States. Now estimated that there are more than 1,000 casinos with at least one in every state. And added to the popularity of gambling online or through a mobile app is it's not surprising that 1 in 5 Americans admit to actually placing a wager. But did you ever consider betting on an election? Well, the practice is not uncommon in Europe and other countries, and while not entirely unknown here in the United States, it's suddenly really come to the forefront. Social media platforms have been regularly posting odds on the current presidential candidates, and there are many who question the validity of those numbers. Well, these odds are often not in agreement with other more established and vetted polls and surveys. The danger is that, true or not, these reports can have an effect on fundraising, volunteering, perceptions, and really ultimately the election itself. Well, the Commodity Futures Trading Commission recently took action to prevent gambling on the outcome of congressional races, suing New York-based Kashi, a company which offers bets of this kind. The commission wrote that these bets, quote, could potentially be used in ways that would have an adverse effect on the integrity of elections or the perception of integrity of elections, for example, by creating monetary incentives to vote for particular candidates, end quote. Well, the CFTC lost that case, and as of now, the judge hasn't shared the specifics behind the decision, but it has brought the conversation into focus. And so what does this mean for the future of political gambling? Well, it's setting a precedent, opening the door to more widespread gambling of its kind, perhaps. Will it have the disastrous effects that some fear, and is it monetizing the democratic process? Of course, all good questions for us to chew on as we approach that presidential election on Tuesday. All right, well, we have covered a lot of ground, certainly in today's show. On November 1st and really this week, and next week is shaping up to be a busy week as well. We've got earnings reports from NYSE listed companies like Cloudflare, Pinterest, and Sweetgreen, that presidential election that I mentioned earlier, and the Fed's interest rate decision on tap. All will be market moving events. We'll also hear from ICE's Harvey Flax on rate projections ahead of that central bank decision on Thursday. All right, well, as always, thank you for watching. I'm Kristen Scholler here at the New York Stock Exchange.
In life, I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.